So we're going to get started here. You should all be seeing my screen. And we're almost ready to go. So can you see it? When I do this, is the chat box visible?
No.
No? Okay.
No, it's just the screen.
Okay.
So we don't see like neither the chat box or that the Zoom bar like on top.
Yeah, yeah.
If you pull that on, we cannot see anything.
Okay. Good to know. All right. It's the bid-witching hour, and it's time to begin. This ACE 444 session. We have our material here up on the website. We're going to do lecture notes week 5, so draw those down. So if you have those, haven't got those already, that's our outline for the day. Enrique will be going over this mutual fund sheet here in a minute or in a little bit, and then stocks finished this week lower as S&P dragged down by tech stocks. That's a Wall Street Journal article that I referred to today. Lecture notes for week 5 are listed here, and this is what those look like. So let me make those bigger. Fill the screen here. All right, we got it to the page width. So first off, starting out, we have a midterm that will be available here shortly after this class. Enrique, do you have any comments here you want to make about the midterm?
About the midterm, I don't think so. I guess just if by chance you run into some I don't know, technical difficulty or you don't understand a question or something, email us, and if something happens, don't panic and don't worry, like we're gonna be taking care of that. Okay, so because you have like 3 hours once you start, so if something happens, just let us know. I guess that's it.
All right, so and you can't see this yet, so don't be looking at your website. This is hidden from the, but you'll click here, midterm 1. There is a handout that's available that you need to go to. You will download that, and then you will go into the midterm. And there is a multiple choice part of it. It's 24 questions, multiple choice. You will need this paper right here to answer that. In my opinion, they're pretty straightforward, but if they're I'm sorry, I'm up to one. Here's the sheet that you will be used, and there'll be 24 short multiple choice answer or short answer. You'll do those on Compass. You'll do that right here. Just to give you a feel, you have 3 hours once you start. Should take about an hour, right, Enrique? Let me close the door here. I got noise coming in.
I don't think so. I think it's going to be very, very straightforward. And by the way, if you missed the review session, it's over there. And the review session is pretty much like the exam. So like before doing the exam, I encourage you to take a look at that. You can put double speed and run that real fast, and no surprises. So expect something like the review session. So I encourage you to watch it before, but it shouldn't take for the multiple part, not even 1 hour, I think.
There will also be a open-ended question. Where do they get that material, Enrique, when they want that?
Yeah, we're gonna put there as well, and I'm gonna open another content for them to submit that.
So there's 2 parts, just to make sure, and we'll reiterate this again over the. Let me pull up this. There are 2 ports. There's multiple choice, And then there's open-ended questions. You will have to download that and complete it and submit it by Compass. Both of those are due next Thursday, which would be October 1st by noon. So you can look at it just an extended homework. So there you go. So tell me, or just if you would, type in the chat box.
Yeah.
Yes. Go ahead. Or could you type or just type in the chat box that yes, we understand that what's going on. So if you wouldn't mind, do that. All right. Thanks, Sarah. Tam, thank you. All right. All right. All right. Conrad, that's a good question. Do we have 3 hours to take both parts? The answer to that question is no. You have 3 hours to do this multiple choice part. All right, right here. You can take as long as you want on the open-ended questions. You just have to have it submitted by October 1 at noon. So this open-ended question, the procedure is pretty much like your homework, right? So you will download it. It's actually a Word file. You'll right.
Yeah, it's a Google Docs, so you can download it. You can just use that, or either way.
All right. So there's what the mud term will look like, and there's review session here, and we'll cover a little bit more about what the exam is going to be like at the end of the session. All right. So here's my question. All right, so let's go in. So what we're going to do now is go through asset tracking. Then we're going to do through homework 4 now already. And then we'll talk a little bit about the exam at the end. So let's start with the asset tracking. Last week, we saw the S&P 500 decline a little bit by 0.64%. I haven't been following it today. What has been, type in your chat boxes, please, what has been happening this past week that have been causing the S&P 500 to go down? So if you would, tell me what's happening in the S&P 500. What did you put in your report this week? All right, people have been selling tech stocks. Yeah, Brian, that's actually right. Tech stocks have been on a downward slide. Anything else? And yes, that is true. Tech stocks. What else have been happening this week? Anything else that we mentioned in the report? Not as easy to get loans. Yes, there's not as easy to get loans. I would also put in here, there's just general concern about the economy. Anything else that anybody wants to mention about what's been going on? General concerns about the economy. All right. So as we looked at this week, and I put this article up here, tech stocks are down again, have come down again. And there's this concern about this tech stock reversion. We saw that as we demonstrated last week. We've seen these tech stocks go up 50 to 60% since COVID-19 control measures were put in place. And now is there going to be some sort of reversion? Are we at an inflection point? Some investors want more information about the stimulus package. I believe that has been wrangled out today, but at the time of last week, the Republicans and Democrats remained at an impasse, and there was some concerns about that overall stimulus package, and then consumer sentiment, as a number of people indicated in that article, increased, but it still remained at very, very low levels. So that is largely what is going on here this week. So I got some questions based on the above article. All right. Let's say you believe in efficient markets. You believe that efficient markets, what would you believe will happen to tech stocks in the next week, month, or year? So type in the chat box what you think. If you're an investor, if you really believe in the efficient markets, what do you believe about the tech stock market in the tech stocks in the next, pick your period, week, month, or year? Let me add something to it. Let me make it more specific. Do you believe the recent correction, recent downward movement if you believe in efficient markets, do you believe the recent downturn tells you anything about what's going to happen next week, next month, next year? Anybody want to venture the guess? Okay. Here is what efficient market means. All right. Past price movements tell you nothing about the future. All right. If you're looking at past price movements, it tells you nothing about the future. There should be no relationship between what has happened last week and what will happen in the next week. If you performed a regression analysis or a correlation analysis where you looked at stock price movement today versus stock price movement yesterday, there should be no relationship. So what if you believe in efficient markets, this correction or any of this discussion means very little to you because you just believe in efficient markets, and there's going to be upward or downward movements in those markets, and all public information is incorporated into those markets, and therefore nothing is included in that information. All right. So you're an investor sitting here today. What are you going to do? Should you get out of stocks, tech stocks, or should you get out of anything that's in these this market situation? And the answer there again, what do you think about, if you're an investor, what you should be doing now? And again, it comes back a lot to your views about the efficiency of markets. If you believe in efficiency of markets, you just get into the market and stay in the market. You don't make movements in or out of the market based on current conditions because you can't predict what's going on. That is what efficient markets mean. And again, a person that would believe in those quite a lot would be the founder of Vanguard, and what Vanguard did with their stock portfolio. So if you believe in efficient markets, you're coming back here and you're looking at those and you're going, stock prices went down. I really don't have a lot of information to base for which to base my future decisions. All right. Let's turn to homework 4. And I'm going to turn this over to Enrique, and you're going to start it.
I'm going to share my screen real quick. Can you guys see my screen over here? Can someone say yes or type? Let me get my checkbox. I don't know, what is it? Yes. Thank you. So like quick announcement, I am almost done, I would say, kind of grading the other homeworks, homework 3. So you should be seeing that probably on the weekend or Monday, I think, along with homework 4. But let's talk about homework 4 here. I always skip question 1, right, Gary, because you're going to be talking about it in a minute. So I'll leave that on you, and I'll jump into question 2 and 3, right? So question 2, we said here, run the CAPM regression analysis on fund X and answer those questions. What is alpha and beta, and the interpretation of those? So here on data, let me just zoom in a little bit. You had here the CAPM equation. Those are just information given, but you have here fund X returns and risk-free returns. So, and also the parameters over here were also given, right? And if you think on that equation, what you were doing is trying to get, all right. You have here the market minus the risk-free, which is this, right? And now with this fund X minus the risk-free, you're getting this part of the equation over here. So to do that, you would just do the fund X returns minus the risk-free returns, and you could do it all the way down. So basically what you have here is the fund X excess returns over the risk-free asset and the market excess returns over the risk-free asset, right? And if you remember that from the CAPM regression over here, I'm gonna draw a little bit. If you had the risk-free rate over here, this line here is, and over here is beta. As beta increases, your predicted return increases. So beta is the only thing that matters for that, that returns, right? And what we are doing here, it's getting a graph of excess returns. So basically that part of the asset, it's over here. And here, the market minus the risk-free asset. So if you run that regression, kind of, you would expect it to be exactly like this, and the intercept would be 0, right? Alpha would be 0, meaning that the CAPM holds, or beta is the only thing that should predict results, right? And that's what we're going to be doing here. So when we run the CAPM regression, what you would do here is go to data analysis. By the way, I think you all got that figured out because nobody asked me that, but should be able to get those in the add-ins section here in Excel. Come to regression, and think on this regression that we're getting here. Our Y range, it's the fund X over the risk-free, and X range, market minus the risk-free. Now note that I highlighted the labels here, so I just check up labels here. I could have just started right on the data, that's fine, and then didn't put labels. I'm gonna dump the result here on the new worksheet, CAPM 2, hit OK, and there is our regression analysis, right? So I hope it's clear what is the regression analysis. Thinking on that equation over here, this like Y equal alpha plus beta times X, right? So this is X and this is Y on this equation. So it's a linear regression, like literally a linear regression. And over here, you should be able to find, let me just hide those floating things, view, 3 lines. Okay, you should be able to find over here alpha and beta. So remember, linear regression, you have a regression like this. This is your intercept, or alpha. And the slope, slope, sorry about it, but it's beta, right? So you will find the intercept coefficient over here and the slope beta over here. So this is beta, this is alpha, right? So this is the first question. What is alpha and beta under the CAPM regression? So alpha, I just highlighted there, linked there, but 0.0039 and 0.26 over here, same thing, right? Then we went further and said, like, interpret alpha and both value and significance, right? So remember, alpha here, it's a measure of excess returns, right? So according to the CAPM returns, this asset should yield X. However, that would hold if alpha was equal to 0, right? Because alpha is different than 0, this alpha, this intercept, is the excess returns are not over here, the CAPM or the benchmark here, because it's the market minus the risk-free, right? So a good way to interpret that is that, remember here we have monthly data. So you could say here that, where am I? Here, oh, okay. So every month, this fund X underperforms its benchmark or the market here, right? By 0.0039, right? It might not be much, but if you annualize it, it might be like a big deal, right? What's the annualized mean needed in homework? You mean like over here? No, you don't need that if you think, right? You're running the regression on this data. This was just given, I think, for help, like to help you like to figure out what's happening. So if you look at fund A, the annualized mean, this is a regular mean. You could do geo mean, but let's say it's 4.5 over here percent. Now you run the CAPM regression over here, and you find that actually this 4%, the market probably performed better. So according to its risk, it did not outperform the market, right? So it's a good measure of excess returns compared to a benchmark, in this case, the market. So sometimes you might see, I don't know, 10%, but what if the market was like 20%, right? So this fund did not outperform or did not deliver good excess returns. And this is what alpha means, okay? So alpha here is negative. And finally, something else that you can, and we probably should interpret here on alpha, it's significance, which you can look at the p-value or t-stat. P-values are often more useful, or shouldn't say useful, because they will yield the same result, but intuitive, I guess, right? So always on the question, if you see, at least for us, if we don't say anything, you're gonna have to make the call. But these results, you can pick a p-value, let's say here 10%, and you're gonna see if p is lower than 10% or higher than 10%. If it's higher, it's not statistically significant. If it's lower, it is statistically significant at this level, right? So if you use it 10% here, you would say it is, because it's 0.6, right? It's 6.4%. So it is statistically significant at 10%, or p equal 10% or 90% of confidence interval, right? Now, if you use it 5%, that's fine. However, at 5%, it wouldn't be significant, right? Because the result is 66.4%. So if you want a 95% interval of confidence, it's not significant from the statistical standpoint, which would mean that I don't care if it's negative or positive, it's not different than zero statistically, right? So that's why this p-value, it's what we use it for. You could have done this analysis for beta as well, but usually we care more about alpha over here. So it's negative and significant and at 10%. 10%, that was my call. If you put it's not significant at 5%, that's a good interpretation, is correct as well, right? So now, according to my interpretation at 10%, this fund did not have excess returns compared to the market, so underperformed the market. However, you could go ahead and say that it was not statistically significant, therefore it is not different than zero statistically, right? So I hope that makes sense for you guys. Now beta, you could have done the formula. I don't think you, I guess you could, get the standard deviations, correlation coefficient. You would get something very close to this number over here. Maybe not exactly, but you should get something very close if you do the formula, okay? And it's 1.26, so remember the interpretation of the beta. Here under the CAPM, the beta is a measure of volatility adjusted or compared to the market volatility. So if it's greater or equal one, if you held the market portfolio, this asset won't bring any additional risk at all. So it moves kind of along with the market. If it's greater than one, it means that this asset is sensitive to market movements. So its results might be amplified for the good or for the bad by market movements. Or if you hold the market portfolio and bring that asset on this asset will bring more risk to that portfolio, right? You can interpret it either way, okay? And if it's lower than one, it's not sensitive, or it's less sensitive to market movements, and you would bring less risk to the market if you held this market portfolio, right? So you could have interpreted the significance here, but here we didn't ask for, but you could as well have done that. And it was, this is minus 73 exponential here, so it's almost zero, so it's significant, okay? Any questions here on this CAPM question, or can I move on to the multi-factor regression analysis? Okay, so guys, I'll move on. And just so you guys know, in the midterm, what we'll probably be given, it's like this table already with all those draws, of course, but you should be able to find where's alpha, interpret its significance, and also beta here, okay? So if you have this table, you can have alpha and beta and interpret that, okay? So you don't need to calculate, but you have to be able to understand that. Okay? You could have gone further and interpret R-squares and something else, but we're not gonna be talking about it right now. Now for question 3, I apologize for the question here and this highlight cells that might be a little bit confusing, but basically we were asking the same thing. However, now you should be able to run the 3-factor model here from in French instead of just the CAPM regression, which has just one factor of risk, right, or beta, one beta. So you should be able to go here to data analysis, same thing, regression, and you're going to be doing the same thing that you did for the CAPM. So your Y variable is still the same. Now for your X variable, what you're going to be doing is you're using more than one factor as risk factor, right? So what you're doing here is you are running a multi-variable linear regression analysis. So let me just dump that on another one, but come back real quick. So if you think about it, you have here Y equals alpha plus beta x1 plus beta 2x2 plus beta 3x3. Something like that, and you could have the error as well, but so this is a multi-variable linear regression that you're doing. And the difference from the CAPM is that while CAPM says the only thing that matters that investors should be rewarded for is beta. So it's kind of taking all the risk that or this undiversifiable risk for that asset and saying, okay, so the only thing that matters is how riskiness this asset is compared to or adjusted by the market riskiness, kind of, okay? Now, in this three-factor model, Fum and French, they documented some effects that were known to play a role here. So for instance, this small minus large here, it's simply like two portfolios, one with small stocks and the other one with large stocks. This is measured by the market cap. And they are taking the excess returns of the small stocks over their large stocks, right? So maybe if you have here done an average, I don't know if it's going to be like too much, but so yeah, this is almost zero, but it's on a monthly basis, so it's a little bit higher. Small stocks outperformed large stocks, okay? So what are you doing here? When you include that on your regression, you are controlling for the factor as well. So you are not saying just the beta that relates with the market is the risk factor. Now we have other factors as well that have been shown to influence returns. And in fact, like small stocks in this case have been shown to have higher betas, right, than large stocks. So more risk and therefore yield more returns. Same thing here for value minus growth. So we have two portfolios here. This is on a book to market ratio. So value here, it's a high book to market, or like a lot of tangible goods, kind of tangible goods or tangible assets, and growth, which is a lower or low book to market ratio. Think of that on some tech stocks, for instance, right, that has lower intangible assets, but it's the same thing, right? And if you would do that, maybe this information is already incorporated in the market nowadays, but historically, value stocks outperform growth stocks. So when we include that, we are controlling for that factor as well, right? So let's say I'm a fund and I invest only in small and value stocks. If I use the CAPM regression, I might have a positive alpha, but it's just because I take more risk, right? Small and value stocks are known to outperform growth and large, right? So what this model does is kind of adjust the alpha or this results for these two factors here, or these two small minus large and value minus growth factors. So it's basically adjusting the fund by its investment style, considering those factors. So you could have added more factors. I don't know, profitability, for instance, if you just invest in high profitable firms, right? And you might include that factor as well and saying, okay, now I'm controlling for that as well. So I'm adjusting for that investment style as well. Okay. And when you look at the results, the interpretation, it's similar, but it has now three betas for us to interpret, right? And the way to interpret that is the same thing here for alpha, right? We have alpha, which is negative. So it means that after adjusting here or controlling for those other risk factors, or adjusting for its investment style here, considering those factors, this fund still underperformed the market here, or its benchmark, let's say, better saying, right? And we can also interpret the p-value here for its significance. So remember on the CAPM, it was close here to, it was 6.4%, sorry. Now it came all the way down to minus than 1%. So now it's significant at 99% confidence of interval of confidence, or p lower than 0.01. This is very significant, right? And we could go over and interpret those three coefficients. This is beta 1, this is beta 2, and this is beta 3. And a good way to interpret those, I don't know if you guys took any like regression course, but try to think if you hold everything out, like other, hold everything constant, but this factor, you show here that market, the market beta here, when market is doing good, this fund is also doing good, right? So you can interpret the market beta pretty much like the CAPM regression beta, okay? It has more risk compared to the market. Now is small minus big and value minus growth here. You kind of will interpret its signs. So over here, it's a positive relationship. This is a negative. You could try to interpret these values as well, but we'll probably focus here on just the interpretation of the coefficients. So holding everything constant, when small stocks have excess returns, right, over large stocks, this fund has a positive relationship with that. So when small stocks are outperforming large stocks, this fund is likely to be doing well as well, okay? You could have said the opposite. So when large stocks are being outperformed by small stocks, or when small or large stocks are underperforming small stocks, this fund is doing bad, right? You would flip the sign. So you can interpret that like either way, but it's the same. I hope you guys noticed that what I said was the same, right? Same thing here for value and growth. So when value stocks are outperforming growth stocks, you see a negative relationship with this fund performance. So when value stocks are outperforming growth stocks, this fund is not likely to be doing well. And conversely, if growth stocks are beating here or outperforming value stocks, we would see a positive relationship here with this fund, okay? So the interpretation of that, so here, I'm sorry about question one. It was just the coefficients here that we were asking. Was alpha significant? Yes, I choose again P 5%, but since we didn't say anything, you could have chosen something else like P 10% or 1%. But usually we're gonna put that on the question. So we're gonna say, consider the level of significance of 10%. So you will know that P has to be greater or lower than 10% to be or not be, or not be or be significant, right? So it means that alpha was negative and significant. It means that even after accounting for this fund investment style, the fund underperformed its benchmark. Again, alpha, it's a measure of excess returns. So negative, underperformed, and it was significant here on that model. Those three betas, so fund is sensitive to market movements. Remember the beta with the market, same kind of interpretation of the CAPM. You would bring more risk to the market portfolio. Now beta 2, that is small minus big, 0.72, it's positive. So it means that the fund has a positive relationship with the returns when small stocks outperform large stocks. So when small stocks outperform large stocks, this fund is likely to be doing well. Okay, I'll shoot at here like likely to be doing, likely, yeah. And finally, beta 3, value minus growth. This fund does well when value stocks underperform growth stocks, because remember, negative sign over here. So you could have said it differently. Does well when growth stocks are doing better than value stocks. Okay. What kind of investment category? We're going to be talking about that on funds. Gary will be talking about it. But remember, we have that small, mid, large, income or value, blend, and growth classification. So what we are looking here is that it has a close relationship with small stocks, and it also has a negative, or let's say a negative correlation with value stocks. So if I would guess here, what would be this fund investment style, I would say small and growth, right? So it's not always like a very like super precise thing, because maybe it's just a matter of the period of time you got, all right? But well, this is what I would guess this strategy, this is the fund strategy, right? Because of the relationship with the return. Now compare the two alphas. So remember alpha from the CAPM, negative 39, alpha from the three-factor model, negative 49, which is even more negative, right? So a good interpretation of that, it is different. So after considering for its investment style, the three-factor model adjusted its benchmark and kind of increased it a little bit. Why? Probably because of the small stocks part of that, right? Remember, small stocks are known to outperform large historically. So if this fund invests in small stocks, it should yield greater returns. So this is kind of the adjustment that this three-factor model is doing over here. So it's saying its benchmark should be actually a little bit higher to represent excess returns, right? So after adjusting for its investment style, this benchmark was increased, right? Because it's small stock. Okay, same thing. Now, when you combine those two effects here, benchmark was increased a little bit, and therefore alpha decreased a little bit. Okay. I think that's it for questions 2 and 3. Do you guys have any questions or comments here on that? I know that it might be difficult to understand, but try to go over it and get the intuition behind it, because it's really helpful and help you making a call on which model to use and how to interpret those. Okay, evaluating your future, I don't know, fund maybe. So with that, I think Gary, you can go over or get the notes back, and then you address question 1, right?
Yep. So you're gonna have to.
Yeah, let me stop sharing. Yep, there you go.
All right, I'm gonna share screen. All right, we are going back to the number 1. And number 1, you should be looking at, and so I'm back at the notes here. Here's what those notes look like, the mutual fund discussion, and you should have looked at Vanguard 500 index and Fidelity Mutual Fund Index. So I'm going to go same format here as on the notes, but I now have this Excel spreadsheet pulled up, and I'm just going to go down the list here and look at those these two funds here. Again, if you're a financial planner, what you're going to be doing, and in fact, if you're an individual too, where most of particularly your retirement accounts are going to go is into mutual funds or ETFs. Mutual funds have a bit different characteristics than ETFs, and we'll talk about that some here later in the class. But I picked out 2 funds here: Vanguard 500 index funds and index fund, and Fidelity Magellan fund. All right, so those were the 2 that you looked at. You could have picked everything or pretty much everything in this list here from either the prospectus, or if you go into Yahoo Finance, where I'm going to go now, you go into Yahoo Finance and type in the ticker symbol for one of these, and I'm just going to do Fidelity Magellan. If I can spell it right here. There we go. FMAGX actually is a symbol. You will see everything about this fund that we need is listed here. All right. As you're looking at these 2 funds, they have a difference in philosophy, which we're going to come to. All right. Zoom in a bit. All right. I will do that a little bit. Let's see if I can 250. All right. Is that better? Hopefully that'll get us better here. All right, Fidelity, first one or second one here. This one actually is a fund, a very famous fund, and you can make the argument that it got mutual fund business going. It was the largest fund for a very long time, and it's a famous fund. Vanguard 500 Index Fund is also a sort of a famous fund as well. Vanguard is known for John Bogle believing in efficient markets, and if you believe in efficient markets, it leads you into two things: making investments in the index, not trying to beat the market. So if you believe in efficient markets, here's where you're going to go. Number one, broad-based index. So you're going to go into a broad-based index fund, and you're going to keep fund costs low. All right. If you believe in efficient markets, that is where you're going to go. You're going to go into a broad-based index fund because you can't pick stocks. So go entire market and then keep your cost as low as possible. So those are those two funds. And now let's go down the list. Both of these funds, investment type, invest in stocks. And as you look at the prospectus, you will see that they will say what investments they will make. That prospectus is actually a contract between you and the company. They should not, and I repeat that again, should not vary from where they are making the investments in the prospectus. They shouldn't vary. Like Vanguard 500 Index Fund, if it stops being an index fund, it would be a breach of contract. It's meant to be an index fund, and if you make an investment into that fund, that is what you're expecting. Fidelity, on the other hand, it believes is an active managed fund. It should not go back to an index fund because it's an active managed fund, so you're buying an active management here. All right, the next two items here are income, blend, and growth, large, mid cap stocks. Those, and I'm going to go to the Vanguard or the website here. And if you go into profile, here's where this is coming from. And by the way, it changed on me. This is growth. I'm sorry, growth. All right. Morning style box here. This is what we're talking about. And let me give you with an understanding of where a stock or a fund is within this box should tell you something about the risk return characteristics of that fund. Okay, if we look at income, blend, growth, and again come back to our box here, I use the word income, they use the word value, blend, growth. As we go up this scale, we increase both the expected return and risk. Okay, so if we go from income to growth, growth has more risk, more expected return than either blend or growth, but or income. So it's a scale. As I move towards growth, and again, so the tech stocks now would be growth funds. Okay, so we are buying an expectation of growth, right? You would not expect a growth stock to have high dividends. If you want dividends, you would go into an income fund. Income funds tend to be low risk, and what you're looking for is a steady source of income. All right, so growth think of tech stocks now, it probably won't be tech stocks in 5 years, but something else, all right? So growth, this one, you would expect more risk, more growth relative to a blend. All right, same thing here, large, mid, small. You're looking here again at small, medium, large, medium, small, and it's if you tell me the fund is a large cap stock versus a small cap stock, it again tells you something about the risk and return. And here, small tends to have more risk, more return. All right. All right. All large cap stocks started as small cap stocks sometime. Okay. So as you're looking at that large, you would expect that to have less growth and less expected return risk than a small stock. All right. If you want to put your money into an investment that has the potential for large expected returns, you would be putting it in a small cap stock, and you could either get very high returns or not so high returns. So that's where those continuums come from, and why you're putting those, why we're putting in those in there. If I tell you this, if I told you I have a large cap stock versus a small cap stock, told you nothing else, you should expect the small cap stock to have a higher expected return than the large cap stock. All right. Next one, index versus active management. Here, index funds are following an index. They have to tell you the index, and the Vanguard 500 fund is an S&P 500 fund index, okay? So Vanguard 500 fund invest exactly as same cap as the S&P 500. Fidelity Magellan fund, on the other hand, is actively managed. It is picking stocks somehow to put in its portfolio. Okay, so it's a matter of emphasis, and if you're looking at the two, you have to you're on active management. You're expecting to see something happen because it's actively managed. All right, next one, objective versus growth or goal. Each one of these funds, and you saw in the perspectives and the objective function section, and that on Yahoo Finance. If you're looking at it, the fund summary here on the profile will tell you what it is. This investment seeks capital appreciation. So right there, its goal. This investment seeks capital appreciation. The other goal of the Vanguard 500 fund is to follow the S&P 500. All right. Next item, portfolio turnover. This measures how often the stocks change in the portfolio. All right. The reason why you look at this is you can sort of tell something about the management style. And let me tell you what the 106% means. If you took the portfolio at the beginning of the year compared to the end of the year, 106% means that somewhere during the year, the complete portfolio turned over at least more than once, right? So during the year, we've seen this portfolio change a lot, 106%. On the other hand, Vanguard 500, next to nothing, 4%. So somewhere during that year, S&P 500 dropped a stock and added a different one. if you think about it, Vanguard 500 is following the 500 largest stocks, and therefore sometimes one stock grows and the index changes. So that's what that 4% is meaning there. Generally, the more turnover you have, the more cost you have, all right? Because there's transactions cost with turning the portfolio over. All right. Then their investment strategy. All right, there's an investment strategy. The investment strategy of the Vanguard 500 fund is to replicate a target index. There's not much to stay there. Once we said this, you really don't need to know this because you got it. However, if the objective goal, there has to be an investment strategy. Magellan says the investment fund invests in either growth stocks or value stocks or both. So they can invest in a wide variety of stocks. If you think about it, growth versus value, that's the whole continuum. It uses fundamental analysis. Fundamental analysis means something very specific. It's looking at the stock price of the stocks that they're being put in there and compares it to their estimate of its value. And it's going to invest in stocks that it believes has low or its price is low, boom, boom, compared to its value. And they are believing that somewhere down the future, those things are going to catch up. So they're going to take into consideration financial condition, industry position, as well as market and economic conditions to select its investment. So Fidelity Magellan is going to pick stocks that they believe have a high chance of having capital appreciation, and in this case, because their price is undervalued relative to the market. Okay. So, total annual cost. This is the amount that the fund takes to cover its cost. Okay. So, if you put $1,000 into this stock, let's say you put $1,000 into the Vanguard 500 fund, their fee is $1.40. This fund, if you put $1,000 in there, is $7.70. All right. All right. If you look at the difference here, 0.77 versus 0.14. All right. So Vanguard 500 has lower cost, and therefore it has to generate less returns to return to its investor the same amount of money. And in fact, you can be quite precise on this. Fidelity Magellan has to generate a return that is 0.63% higher than the Vanguard 500 just to maintain the same returns as Fidelity Magellan. All right, and if you think about it, that's very important. 0.63% is a pretty large, 0.5%. These people have, through their management, have to generate a higher return by over 0.5% just to keep their investors at the same level. Okay. So in general, all right, again, coming back, Fidelity is believes in active management. Vanguard, we're going to keep costs low, and we're going to follow an index, and we're going to let the item follow the market. All right, load cost. This is the amount, and neither one of these funds have loads. Some farm funds have loads. Those funds with loads tend to be the funds that are, for example, small cap or international. Okay. And let me, those some of those funds can have pretty high loads. So let's say it's a 3% load, which neither one of these are. That would mean if you invested $100 into that fund, they would take $3, 3%, as a fee and begin the initial investment at 97% or $97. Over time, funds have moved away from load cost. There were some funds also have back load cost. You take it out when you take those funds out. Okay. Finally, we list here past performance 1 year, 5 years, 10 years, and then a relationship to market. And this is the beta, 1.97. Now I'm going to go to Fidelity Magellan, okay, and the Yahoo Finance, and let me go into the risk section. All right, if you look at the risk section, I tend to look here when I compare funds to this section right here, rather than look at the prospectus. And there's nothing wrong with the returns in the prospectus, but if you look at the prospectus returns, sometimes they don't have the same period. So the Yahoo Finance and most of these other sources try and keep the so 3-year fund, it's beginning, both of these I would presume, I don't know this for sure, would be beginning at the end of August. Whereas if you look in the prospectus, some might be beginning in August, the others in June. It depends on the ending date of their fiscal year for each one of those funds. All right, we have alpha, beta. We have 3 years of data, 5 years of data, 10 years of data. All right. Now let me tell you what this, all right. Here, Fidelity has a 3.92% alpha. And what that means is that for a investment of 0.97 beta, it had a 3.92% average annual excess return. I'm presuming that that's significant. They don't generally tell you if it's significant or not, but 3.92%. All right, it's positive. It's a high return. So in the last 3 years, Fidelity Magellan has beat the market. And you can see that in its returns. Look, past years, 7.37% compared to 16. Past 5 years, 10.58 versus 12.08. So Fidelity, it's beat the market in the last 5 years. But if we look at 10 years, Vanguard 500 actually has beat Fidelity in the last 10 years. All right. So if we're to look again, coming back here, you'll see alpha, boom, boom, boom. 10 years, it's negative. So something may have changed about its management, that it's better in the last 5 years, or the management objectives allowed it to have higher returns in the last 5 years. In any case, those are time dependent. Beta, you can see 0.97 3 years, 0.99 5 years, 1.04 in the last 10 years. So this stock has gotten a little bit less risky compared to the market, but has beat the market. Okay. You also see here some of the other things we typically talk about: standard deviation, Sharpe ratio, and trend ratio is another ratio, but here you see the Sharpe ratio, and the Sharpe ratio has gone up over time. All right. So as you're working, so that gives you this this mutual fund ETF characteristics right now. We will be coming back to those when you begin putting to your portfolio together for your retirement fund. All right, so you're going to put probably a stock in there, and you're going to make a choice. I would suggest you choose a mutual fund. There's a lot of mutual funds to choose from. Let me just show you Vanguard 500. And I'm going to Vanguard 500. Fidelity has a similar list of list of funds. Let me go to personal. I want to show you, and I show you list of funds here, and I always have trouble with this. Yeah, investment products, mutual funds. All right. Here's a list of mutual funds that Vanguard 500 Vanguard has. You can see that. So if we start out with money markets, which we'll talk about next, bond funds, which we'll talk about in the next module. There's several here. We got some balance funds. But let me just give you a feel for the stock funds. Here, we've been talking about the 500 index. There's the Admiral shares here. There's diversified equity. There's dividend growth, equity income, FTSE, which is a European exchange, growth and income, high dividend yield, large cap, prime cap. So you have a lot of funds to choose from. Here's large cap, here's mid cap, and here's small cap. Okay. And then you got differences in growth perspective as well. And all of those will have differences in risk return trade-offs. So as you're looking at this, we could have a fund sheet for each one of those, and it would tell you something about those funds. All right. And again, if you're a personal financial manager, the firm you go with, they may have their own funds, and you will be putting clients in those own funds. All right. Questions or comments here? If you got any questions, let us know. Let me go back to our outline. I've done all this, talked about those, alpha, shown those. You can see there, shown the difference between VFI and X. By the way, this alpha here is 0.14. That happens to be the load cost, roughly the load cost over time. It has an alpha that's less than the market because it has a management fee. All right. All right, topics for the midterm. Here they are, so you should know those. I would also point you to the review session that went on Wednesday. Again, the midterm will be available here after class, and you have till next Monday to complete, or excuse me, next Thursday, October 1 at noon to complete it. Okay. So I will stop there. Got the midterm. You also have, by the way, you still have your asset tracking due on Tuesday. So we're going to keep the asset tracking going. And you have your midterm to complete by next Thursday, October 1st at noon. Appreciate your time today.